Welcome. We're here today to talk about a massive structural shift that's happening right now in the technology sector. It's a fundamental rewiring of where value is created, and it's forging a completely new class of winners and losers for anyone invested in this space. This is what we're calling the Great Decoupling.
So the central question we have to ask is this: why are some tech stocks just accelerating at a rate we've almost never seen before, while others, the ones that used to be market darlings, seem to be hitting a wall? The answer, it turns out, lies in a really powerful and frankly under-discussed trend that's splitting the market into two totally distinct classes of assets. And the engine behind it all is, of course, artificial intelligence.
To really get what's happening now, we have to start with the old guard. I'm talking about the dominant cloud infrastructure utilities that absolutely define the last decade of tech investing.
For years, companies like Snowflake built their entire empires on this powerful principle called data gravity. The idea was actually pretty simple. Get a company's data into your proprietary format, and then the sheer weight and cost of trying to move that data would lock them in forever. It was the ultimate Roach Motel strategy, right? Data checks in, but it never checks out. And this created an incredibly sticky, powerful, but let's be honest, a very closed ecosystem.
But here's the thing. That moat is being systematically dismantled. The rise of open data formats, especially Apache Iceberg, has created what I like to call a USB-C for data moment. All of a sudden, data can live in cheap commodity cloud storage, and basically any compute engine can access it. This has just shattered vendor lock-in. It's commoditized the storage layer and forced a real, genuine strategic crisis for these incumbents. The walled garden is losing its walls.
And you can see this pressure playing out in the financial data. These once hyper-growth companies are now slamming into a maturity wall. Just look at the chart. Snowflake's growth has slowed to 29%, Datadog's to 28%. Now those are still solid numbers, don't get me wrong, but they signal a very clear downshift from their explosive past. It's a transition toward a much more utility-like profile.
Okay, so while the old guard is maturing, a new disruptive force is coming in. And it isn't just challenging their model, it's completely rewriting the fundamental economics of software itself.
The one concept you absolutely have to understand here is what we're calling the AI kill line. This is that critical point where software stops being just a passive tool that helps a human do their job better, and it becomes an autonomous agent that is the worker. This isn't just some minor upgrade, it's a massive phase shift. And for the very first time, it decouples a company's revenue from its customers' employee headcount.
What this means is a fundamental change in how you make money. The old SaaS model, the one based on per-seat pricing, it basically monetized human labor and all its inefficiencies. The more employees you had, the more software seats you bought. Simple. But this new AI-native model, it monetizes autonomous outcomes. It prices against the actual work the AI performs. So any company that fails to cross this kill line is literally monetizing the very thing their technology is designed to eliminate.
Now this might sound a little theoretical, but the hard data that shows this great decoupling, it's already showing up big time in the public markets. So let's look at the proof.
This chart, wow, it reveals a stark, almost violent contrast. On one side, you have Snowflake's growth slowing down to that utility-like 29%. On the other, you've got Palantir, a true AI-native company whose U.S. commercial business just exploded by 121% year over year. This isn't just a difference in degree, it is a difference in kind. This right here is the decoupling point in action.
And what's really crucial here is that this isn't growth at all costs. Palantir is pulling off this insane acceleration with extreme efficiency. Their Rule of 40 score, that key SaaS metric combining revenue growth and profit margin, is an incredible 114%. I mean, that is nearly triple the industry benchmark for what's considered a healthy, high-growth company. This is hyper-efficient, profitable growth at a massive scale.
The engine driving all of this is a completely different way of selling. Instead of pushing software seats, these AI-native companies are selling outcomes. Their bootcamp model is all about solving a specific, high-value business problem in a matter of days, not months. This just compresses the sales cycle and delivers real, tangible value almost immediately. It aligns their success directly with the customer's results, not their headcount. So, as an investor, how are you supposed to interpret this clear split in the market? All right, let's deliver the final verdict. For the AI natives, the companies we call the AI compounders, the bull case is pretty straightforward. They are on a path to become the new operating systems for the autonomous enterprise. The revenue is totally decoupled from human labor, which allows them to capture value directly from the massive labor budgets that their tech displaces. Think about that. They aren't selling a better tool for the worker, they're selling the worker itself. On the other side of the coin, for the infrastructure utilities,
The risk is a slow, grinding descent into commoditization. They're facing pricing fatigue from customers, relentless pressure from the hyperscalers who can just bundle services for free, and the existential threat of becoming a dumb pipe. You know, the essential but low-margin plumbing that just holds the data, while the AI agents on top capture all the value.
This table really brings it all together. The core takeaway is this. We are witnessing the birth of two fundamentally different asset classes. In tech, you have the AI compounders, driven by outcomes and seeing their valuations expand. And you have the infrastructure utilities, driven by consumption and facing valuation compression. These are just different businesses, with totally different growth drivers, risk profiles, and ultimately, different futures.
So as we wrap this up, it all comes down to one critical question for you as an investor. As artificial intelligence makes this profound transition from being a tool that helps human labor to being the laborer itself, you have to ask yourself, is my portfolio invested in the companies that sell to the labor, or is it invested in the companies that are building the new labor? That is the single most important question you need to answer to navigate the next decade of disruption.